Welcome everybody. Like I said, my name is Tom Long. On behalf of AuraFX, I certainly welcome you to today's webinar, High Probability Breakout Trading, with kind of an angle on looking forward to November, try to figure out where the markets might be going to in the month of November. We're going to take a look at some charts here, some live charts on the daily, work our way down to some intraday charts. But first of all, what I've got to say is this is kind of dangerous ground when we're talking about where the markets might be going in November, because any of you that have been in any of my previous webinars, you know that one of my favorite sayings is a good trader predicts and does not predict, but rather reacts. Predicting is a very, very, very difficult thing to do, particularly when you become married to that thought process that you can actually figure out where the market is going. I think you'll find that the best traders in the world just don't get into that game. They keep an open mind about what the market wants to do, since the market is always right, and they react to what the market does rather than try to predict what it does. Now, it may sound like the same thing, but there is a big, big difference between the two. For instance, some new traders who like to predict the markets will get into the idea that the euro is going up and they'll buy it. And then if it doesn't do what they expect to do, they'll buy some more, or they'll really get themselves in trouble because they think that if the market does opposite of what they predicted, that's a reflection of their ability to be a trader. But anything could be further from the truth. That is really not trading. That is the game of predicting. What we want to do is to get into trading, we want to see what the market is going to do and try to take advantage of it by reacting to that rather than getting into an idea the market has to go up or the market has to go down. Because anybody who's traded more than an hour will find that that just doesn't work out all the time. As a matter of fact, quite often the market does opposite of what some of the best traders think the market might do. But again, because they have kind of a thought process in mind, because the market is doing the opposite, they have the flexibility and the confidence to quickly change their position or change the trading bias that they previously had and be able to take advantage of it. And that's really the mindset we want to get into when we look at these charts and try to see where the market might be going in the future. Because we're going to be looking at some key points here, and only when the market trades through those key points will we be able to get a better feel for what the market wants to do. I always like to say before the market can hit 101, it's got to move through 100, and until it does that, it's not going to 101. I mean, that may sound like a very, very silly thing to say, but as a matter of fact, sometimes you'll see where new traders, particularly new traders, will get into the game of telling you that the market's going to move up to there, it's going to reverse and move down to here, and reverse again and move up there, and that's when I want to go long. Well, if you can predict that many turns, then you're in the wrong game. You should be predicting greater things in life. But remember, this game is really not about predicting, it's about reacting to what the market does itself, because it's the market that's always right. And remember, what we're doing here is speculating. The funds we're using are speculative funds. The risk reward is not just a fancy term, it is real, because most of the time we're looking for high reward. That means we have to be willing to accept high risk. We have to be okay with losing, because I guarantee, the one guarantee in trading is that if you trade, you will have losing trades. That is the only guarantee. And so we have to be ready to accept that. Now, the way that we're going to teach that is only take on the risk that you're capable of, that you're comfortable with. Because any more, then you get into that zone where you're not comfortable and you start making decisions based on your emotions rather than based on good analysis. So we want to keep our risk tight. We want to keep our risk comfortable, but we have to be able to take risks, though, in order to realize some of the reward. We want to realize, though, that this game can and has taken more money away from people who have had in their accounts. But we want to make sure that we're in a position to keep that happening just to the next guy and not ourselves. And the way we do that is money management, identifying our risk and sticking to that risk. Now, what is breakout trading? In my opinion, the most important point that we can look for in technical analysis is a strong trend. Okay, and I want to tell this story because it's so true, and it happened almost month after month. I used to work for one of the largest brokerage firms in the world in currency trading, and we would have a trading contest every month. And we would see some incredible returns, particularly from the countries where They didn't have as high a margin requirement as, say, in the U.S. And some of these traders would have 1,000% return a month, and they would think that they found it. They'd found it. They were genius. They were ready to quit their job and just trade, because it doesn't take a math genius to figure out 1,000% a month. In a couple of years, you'd be able to own Google or own half the world, and that's what they were shooting for. But what happened? What happened was the next month they would lose just about everything they'd gained in the previous month and some of the original account balance, and they would sit there and just stare at the screen blindly for a month or two before they would contact us to find out what happened, what went wrong, and how can they fix it in the future. Well, what happened was they found themselves a strong uptrend or a strong downtrend. Say they found the pound dollar was just moving up strongly for the whole month. It would pull back 50 pips, they bought some more, and this trend would reward them by moving up to a new high. It would pull back 50 pips, they'd buy some more, the market would reward them by moving up to a new high. And they would do this for a month and figure, well, this is easy, there's nothing to this. But what happened? What happened was the next month, they didn't understand where the uptrend changed to a downtrend, and every time the market pulled down 50 pips, they bought more. The market pulled down another 50 pips, they bought more, and as you can see, it doesn't take long before they would end up losing everything they gained in the previous month. But what they missed was the first step. They found a strong uptrend that was making a series of higher highs and higher lows. This is what it looks like on a chart, and we'll look at some good live examples here in a few minutes. But it looks like a stair-step formation moving up or down. Some of those stairs are big, but that's fine. But it still looks like a series of higher highs and higher lows and an uptrend. And what we want to do is try to buy either at the low, or some traders will wait for the breakout, wait for the market to make the low, and then buy as the market moves up to a new high. We'll get into that again here in a second. But we want to remember this. Number one point about trading: if you can find a strong uptrend, you can use just about any approach to buying as you want, and you increase your chance of success dramatically. Okay? It doesn't matter what you're using. The key is, are you buying in a strong uptrend? Are you selling in a strong downtrend? And are you avoiding a market where the trend is not clear, which is where we are right now in the daily charts on a lot of currency pairs. But we'll get into that in a couple of minutes. Okay? Now here's the key. An uptrend changes to a downtrend when the market trades down through the previous low. Okay? That stops our series of higher highs and higher lows, and hopefully starts a series of lower highs and lower lows, which is what? Which is going to be a downtrend, the series of lower highs and lower lows. And in this environment, we want to look for selling opportunities only. Okay? Because in the perfect trend, that move from a high to a low would be 2 steps, and the move from a low to a high would be 1 step. But we know that sometimes markets can really move a lot in the trend, and that move from a high to a low can be 5 or 6 steps, and still that move from the low to the high can be 1 step. Okay, and it just makes common sense to, when the market is moving down more often than it's moving up, to look for selling opportunities, because quite often when we trade, our entry is not as perfect as we like it. Sometimes it seems like every time our entry is not as perfect as we like it. But if we're selling in a strong downtrend, sometimes that trend can help our entry look a lot better than it initially was. Okay, that is a big edge to trading, a huge edge, and one we want to take advantage of as often as possible. Remember, trading here is a zero-sum game. For every winner, there's a loser. By trading in the direction of the trend, we're forcing the trader on the other side of that trade to trade against the trend, and now that trader has to deal with being on the wrong side of the strong trending market. Okay? Embrace the trend. It is one of the biggest edges that we can have. I noticed on the AuraFX website there are a few references to the trader Paul Tudor Jones, one of the most successful traders of the last 30, 40 years. I saw a video on him trading, and in the middle of the video, he turns around, talks to the camera, and says, "I don't understand why people don't trade with the trend. It would make things so much easier for them to become profitable." Okay? If you know Paul Tudor Jones and you're a fan of Paul Tudor Jones, then take that piece of advice and embrace it and use it as part of your trading approach. We first want to identify strong trending markets and look for trades only in that direction. We don't want to predict when the trend is going to end, because we don't know, particularly in the currency markets. Some of these trends on the daily charts can last 2 to 3 years. That is a very nice environment to be a buyer, a consistent buyer. Okay. Does that mean we're going to win every time in that environment? Absolutely not. But with money management, what we're also going to talk into here, our goal is going to be to try to win at least half of our trades and set it up till we make twice as much when we're right, when we lose when we're wrong. Okay, a downtrend changes up to an uptrend when the market trades through the previous high. Okay, so it's just the opposite of an uptrend changing to a downtrend. By the way, if you have any questions here, you can go ahead and put them in the chat box. And as we move from screen to screen, we can address them if there's anything particular that's on your mind. But this is going to be key also, is when that market trades up through the previous high while in a current downtrend. Now, to me, this does not mean that we automatically look for buying opportunities, because I like confirmation. I'm a little bit more conservative in identifying my trends because I'm using real money to trade with, and I assume you are too. But this means that, to me, that the downtrend is over. This means that it's time to move to another currency pair, look for a better trending environment, and concentrate on that one to look for trading opportunities. I trade 28 currency pairs of all the majors, and the combination thereof, everything from the euro dollar down to the CAD Swiss. I'll trade 28 currency pairs. There is usually a strong trending market on the daily chart in a few of them. Sometimes it seems half of them are trending strongly. But at the same time, if I don't find any strong trends on the daily chart, I'll move down to the 4-hour and even the hourly chart, and you'll always find a strong trending market. 28 currency pairs, 28 different vehicles to choose from is quite a bit, and it's something we want to take advantage of. Yes, Diego says, and Paul Tudor Jones attributed with the quote that the best money is made at the market turn. And what he's talking about is when the trend changes, trying to identify, as an experienced trader, the money is made the sooner you can identify that trend change and the sooner that you can get in on it, because these are long-term traders that we're talking about. You won't find, these guys trading short-term anymore because they have so much money under management. They cannot sit there on a 5 or a 1-hour chart and get in and out multiple on a daily basis. They're trading on the daily chart. So they're looking for the turn on the daily chart, either getting out with a profit when they see the trend changing, or getting in on a new trend when they feel that the fundamentals and technicals are lining up to go to the same way. Yes, he is. And he's talking about a trend change there, which is exactly the slide that we have up here. If we can get to this point and identify that the trend has changed and get out, then we're going to be one of the first ones to get out of it. Hopefully, if you're a longer term trader, you've been riding those waves down to that low. Or if you're a shorter term trader, you're taking advantage of those highs and lows, those movements at the same time, and understand when it's time to move on to a different currency pair to look for those trading opportunities. And to me, that's what I interpreted his meaning when he said that is not picking tops and bottoms. However, noticing, being one of the first to be able to recognize what a trend change looks like, and that's what we're doing right here. Thank you. Now this is what we're looking for in an uptrend. It is the ABC move. Some people call it a 1, 2, 3 move. This is not to be confused with Elliott wave analysis. Traders, particularly I'm originally from Chicago, and I learned my trading from traders who were at the Chicago Board of Trade and Chicago Mercantile Exchange, and they've been talking about ABC and 1, 2, 3 moves long before Elliott Wave had written his first piece of work back in almost 100 years ago now. But certainly earlier than when Bob Proctor reintroduced it back in probably the early 70s. But this is just a good old-fashioned ABC move, and this is what it looks like in an uptrend. And what we're looking for here is there are two types of traders. It doesn't matter which you prefer. The one type of trader likes to buy. Now, if someone said they'd like to buy the pullbacks, they're talking about trying to buy at point A or trying to buy at point C as close as possible. And they will use technical indicators, whether it's just stochastics or MACD, whatever they like to use, to help identify that turning point. Again, what Paul Tudor Jones mentioned was at the market turn. A lot of money can be made at that market turn if you can identify point A and get it as close as possible to that point, and then ride it up to point B, and notice when it is starting to move down to point C. That is where the money is made. Now, a rule of thumb is top-notch traders, if they catch half that move from A to B, consider it a good trade, and I want you to think of that at the same time. We have to be a little bit easier on ourselves. This is a very, very, very tough game, one very worthy of spending time learning, but there is a learning process. It's like golf. You can buy the best set of golf clubs money can buy, but that doesn't make you a golfer, okay? You can buy the best software and the best charting package you can find, but that doesn't make you a trader. It's screen time. It's practice. They say 10,000 hours is what a musician needs to become, prolific at their instrument. Instrument. It takes screen time and it takes practice. And in the beginning, we can use a demo account, but my preference is using a live account, but trading small, not getting crazy about how much risk you're taking in the beginning until you start to get to be a break-even trader, and then you can start picking up the size a little bit. But be nice to yourself. Don't be as difficult, don't be as hard on yourself as some people are, some other new traders are in them. But it's a learning process, but believe me, it can be learned. Trading can be learned. It's not something you're born with. It can be learned. But as the first group of trader is going to try to buy at point A, the second group of traders are going to try to buy as that market trades off of point C and moves up through point B, otherwise making a new high, which is called a breakout, okay, which is where I get the title of the webinar, High Probability Breakout Trading. If you find a strong uptrend and you wait for that market to pull back, and then you wait for that market to move up through that previous high, that is a very high probability breakout move, and more often than not, that market will continue to move in that direction of the trend, okay? Now, more often than not can mean 51%, but traders can make a living off of a 51% kind of move. As a matter of fact, quite a few of them can make a living off of a 33 or 40% move because they make so much more when they're correct. They know how to work the trade and get as much out of that trend as they possibly can, that they don't have to win 75 or 80% of their trades to be profitable, okay? A very difficult thing to do. Try not to put yourself in that position. We want to think of trading as kind of a coin toss, okay? Heads I win, tails I lose, okay? Now, if I'm betting $1 every time, it doesn't take, again, it doesn't take much to realize that I'm going to get heads about half the time. Maybe after 10 flips, there may be 7 or 8 times it came up heads. But as I get closer to 100, the sampling is going to take over, and it's going to be about a 50-50 proposition, head or tails. So if I make $1 when I'm right, and I lose $1 when I'm wrong, I'm going to be a break-even trader, okay? Now, something has to change for me to be a profitable trader. And trust me, it's a lot easier to change the money management process rather than change the number of times that the coin is going to come up heads. Okay, meaning I want to put myself in a position where I can make $2 when that coin comes up heads and only lose $1 when that coin comes up tails. Okay, so now all I have to do is win a little bit more than 33% of the time, and the situation changes dramatically. If I can win half the time and make $2 when I'm right, and lose $1 when I'm wrong, again, it doesn't take a math genius to figure out that I'm going to be wildly profitable over a long period of time. And that's what traders, professional traders, have on their side. They have time. They have confidence knowing that all they have to do is the same thing they've always done before, and they can be pretty well assured that the results are going to be similar. Now, like I said, there's no guarantees, but we've had some traders who have been in this market doing the same thing for 30, 40 years, because when they see this happens, they do that. When they see that happens, they do this, and they use the strong money management approach that they've been successful for 30 or 40 years, okay? Those are the kind of traders that we want to emulate and we want to imitate in our trading approach, okay? So this is the ABC, only looking for buys, only looking for buys. If you like trying to buy the pullbacks, you're looking to buy at point A or point C. If you're a breakout trader, which increases your chance of success, but obviously there's less room there to profit if you do catch it right. You got to give up one for the other. Like I said, you've got to give up risk for reward. It goes hand in hand. But my preference is more along buying at point B and looking for strong trending moves. My strength has always been to try to identify the strong trends, and my strength has been to have the patience and discipline to demand those strong trends before risking any money. Oh, those are two very, very tough words, patience and discipline. But I got to tell you, if you can exercise those are two of the highest paid traits a trader can have. If you can exercise patience and be disciplined in your approach, you increase your chance of success tenfold by traders who cannot. And I mean that seriously. Those are the highest paid traits a trader can have. Because a newer trader, when there's nothing really setting up, will just get into a trade because they need something to do. They're hooked on the action. Okay, that's what they're for, that's what they're there for. The action. They want to trade, get in, get out, buy, sell. They don't think about winning, losing. It's rather just buying and selling and getting in and out. Where a professional trader is there for the money. They find their excitement through somewhere else. What I did is when I was having issues with that, I would have a live account and a demo account, and I still do to this day, to where if the markets are moving slowly, but I just feel like something to do, instead of risking real money, I'll throw up a pretend trade or practice trade or two in a demo account. Always looking for different approaches, always looking for different games, but to keep my mind active and to keep my mind in the game. Because when the trends do start, trending, when the markets do start trending, you'll find that a lot of them will trend at the same time, and there's plenty of trading activity to get involved in. So when that happens, but markets do love to inhale, exhale. They are living things. Why? It's because they're reacting to a lot of the traders' emotions. So they will inhale, exhale. They will change. Volatility is one way that we can measure that, and of course the strength or the weakness of the trends is another. So in a downtrend, we're looking for selling opportunities only. And again, it's the same thing. We're either going to look at buy at point A, or as the market moves down through that previous low, or buy at point C, or as the market moves down through point B, thereby again selling on the breakout down to a new low, which are fantastic words in my mind. Being short as the market moves down to a new low. I love being in that position, as should you. Okay, let's enough of my drawings. I was able to use a ruler on that, so my lines were fairly straight. But let's move on over and take a look at some charts here. Wait for the screen to catch up. Here we go. There we go. Okay, what I'm going to, I just have a this is just freestockcharts.com. It's a free site on the website. I use that because I like the fact that people in the webinar can see it easily, particularly the currency pair, which we can see the watermark in the middle. Kind of keeps the confusion about what pair we're looking on. Now this is the Euro US dollar. This is the one I always start with because obviously this is the most actively trading vehicle on the face of the earth. Yeah, more than the S&P 500, more than the bonds, more than any European indice. The Euro dollar is frankly the most active market on the face of the earth. So it's always a good place to start. And as we can see starting off to the left, now also what I have on here, now this doesn't matter. This is not a recommendation, but I have a 50-period exponential moving average on here at the same time. Okay. I like to try to what I call idiot-proof my charts. Otherwise, I can see that there's a strong trend, as the market is at the end of 2014 and the market's kind of moving sideways in 2015. But I just like to have some sort of a reference point on there, particularly when I'm looking at two charts to try to figure out which trend would be stronger than the other. So I have this on here for me. Whether you use the most popular technical indicator in the world is the 200-day simple moving average, whether you use a 100-day simple moving average, a 100-day exponential moving average, in this case it's a 50-day exponential moving average, it really doesn't matter. It's just a reference point, and one is not better than the other. It's just a matter of a preference. Okay, I prefer to have them a little tighter, because I want to see, some of the quicker moves in the market. Now, as we can see, as the market starting off here from the beginning of the chart moving down to March, we can see this is a classic example of a strong downtrend. You can see nothing but ABC moves, and maybe a little hiccup every now and then, but again, just some classic ABC moves. And this is obviously a perfect environment for a trend trader trading on the daily chart, particularly on a investment like the euro dollar, which has a lot of liquidity and can take the big traders' money, and they can really load up in a position. Just the perfect world. This was really more dollar strength than anything else. Now, but since then, if you'll notice, the market's been kind of moving sideways, okay? And in October, we had a market that started off moving up and then moved down, but nothing like we saw last year. Like we saw some months here where the market just moved down for the whole month. And this is the type of environment where you'd see some of those traders in the trading contests think that, that they're geniuses, and when in reality all they really did was confuse brilliance with the bear market, and which is not uncommon in the markets, but it, which is not uncommon in the markets, but it's something that I don't want any of you guys get caught up in. But even if you're trading on a 5-minute chart, take a look at the daily chart, the longer term charts, to try to get a feel for what the market is doing. And obviously trading in this environment is easy. We were looking for selling opportunities. It really didn't matter what kind of approach to trading you're using. If you're using a daily chart or some of the longer term intraday charts, it was rewarding traders time and time again for only looking for selling opportunities and not for buys. But right now the market is kind of, well, you can call that an up bias if you'd like. To me, that looks like a sideways market, which is really unclear about the direction it wants to go. The reason it might be moving slightly to the upside is because all of these traders are getting rid of their short positions, kind of giving it an up bias. But this is a market that really doesn't know which way it wants to go. But we're here to talk about what to look for, not so much for October, but for November. And as we go through the euro pairs, we're going to see a common theme here. But right now, I want to talk about the dollar. And we can see that the dollar really hasn't, again, it's in the same situation, not sure about which way to go. Now, I like to go through all 7 of them to see if the same thing, and it's very easy to see that we weren't talking about so much euro weakness, but we were talking about US dollar strength. Remember, the British pound is the first currency pair, the base currency, the counter currency, US dollar. So if this market is moving down, that means that the counter currency, the US dollar, is stronger than the British pound. When this market is moving up, that means that the first currency listed is stronger than the second, okay? And right now we have something very similar going on with the pound dollar that we do with the euro dollar, which tells me that this is really based off of what's going on with the US dollar. And that, of course, is the Fed going to raise rates, or is the Fed going to leave rates alone? We don't know. We keep looking for them to raise rates, but as of yet that has not happened. But again, we have the same thing here. We have the market starting to move down here. Now we have something opposite going on with the dollar yen, because the US dollar is the first currency here, the base currency in this situation. But again, it's the same thing. We saw the strength, and now the market's moving sideways. And along with the dollar Swiss, by the way, I've said this, I think I've been saying this for going on 7 years now. I have not traded the Swiss franc because of the Swiss National Bank is really keeping a close eye on this. And just when you thought that they weren't, we see a move like this. And I hope none of you were caught in that. But that was a pretty traumatic situation for a lot of brokerage firms and for a lot of traders. But that is what happens when a central bank in any country comes in and tries to manipulate the market. And the Swiss National Bank has been keeping an eye on it and manipulating it off and on for 7 years now. So I just don't trade it. I just don't trade the Swiss franc. It's just not a game I want to get into because I don't want to get caught into these moves. If it happened for my position, certainly I would be happy. But at the second time, I would know that that was blind luck, and blind luck is not something I want to add to my analysis. I prefer it to be based on the technicals, based on the fundamentals, and I'll leave luck to the other traders. Okay, now here's a kind of a different situation, and this is one that we're going to come back to again, the Aussie dollar. We can see how strong on the daily chart this market's been moving down, and we saw the market start to move into a sideways pattern, but now has started to move down again. Now, whether it's moving to a sideways pattern or not, we don't know yet. But these are the key points we're going to watch. This is one thing that we're going to watch here, and this is one that we should all watch, and that is that Aussie US dollar. Have it moving down, particularly moving down through that 70 level, because that is what's going to be some support. And we're talking long-term support here. And if the market is moving down through that 70, even down through, let's see, where are we here? About 69. If it moves down through the 69 level, then that is a classic example of new long-term lows. And you want to be a seller at that point in time. You don't want to be a buyer. You want to be a seller. As a matter of fact, there's really nothing here to say that you want to be a buyer unless you're trading short-term and you cause some uptrends on the short-term basis. But on a daily chart, we want to keep an eye on this. And even if we're trading the short-term, I know I like trading the Australian dollar and the Kiwi to the same point, whether it's matched with the US dollar or the Japanese yen, which are a couple of my favorites. It really doesn't matter. I just like the way they trade. I like the trends in them. But this is something I'm going to be keeping an eye on, even if I'm trading short term, is how this market, it's moving down right now, how far it's going to move down. It's possible we can find some bounces here, but if we find some bounces, don't get caught up into the game where it's the trend is changing. Okay, not necessarily. I mean, we're still seeing some ABC moves here to the downside off of these high here in May, and we're going to see if that continues to play out. So keep an eye on that one, and for November, because if it does move down here through the beginning, even we don't have a lot of time here for the end of the month, but if it moves down here in the beginning of November, and it can move down there in a day or two, then watch for some more selling pressure on the Aussie dollar going forward for the month of November. The Kiwi's a little bit stronger than the Aussie, but you can see here we're in a similar situation. That sideways action really didn't play out as much as it did in the European pairs, meaning the euro and the pound, or even the Japanese yen. But the Australian dollar is much closer to those lows than the Kiwi, so we want to keep an eye on that one. And the dollar CAD is a similar situation. The CAD is weak, particularly weaker than the US dollar. And this one is very, very close to about going up to the 134 level. So these are particularly these two pairs, the Aussie dollar and the dollar CAD. I mean, we got some potential breakouts here going on the long term on the daily charts. And if we do that, we definitely want to adopt those biases. Even if you're trading down on the hourly chart, if you're trading in the direction of that trend on the daily chart, boy, that's just one more edge, one more angle, one more thing that's on your side. And really, trading is nothing more than try to identify as many edges as you can and take advantage of them. And so that's what we want to do here, particularly on these two pairs going forward, is take a peek at them. So I said we wanted to take a look at the euro, and we can see that the euro is stronger than the CAD, up until just a point here. And I'm going to go through these quickly because it was really nothing more than that I really wanted to talk about, because I really like the Australian dollar and the dollar CAD. So as a matter of fact, what I wanted, now we'll go through them just to see if there's anything. Again, oh, I'd be so tempted, but it's a Swiss franc. Even with the yen, just not interested. Just not going to get into that game. So we have the Kiwi yen and down to the pound CAD. Again, the dollar being stronger. The pound Aussie. Pound Aussie is a little bit more volatile pair that I really do like to trade also. And you can see that's getting pretty close to making up to a new high. So these are the things that we want to look for in November. We want to be prepared for them. But more importantly, we want to be prepared to take advantage of them. And okay, nothing going on. Now I wanted to get down to some intraday stuff and And let's start off with the 4-hour chart. Now, the 4-hour chart in the currency markets is referred to the dealer charts. And you'll find that quite a few institutional type traders will trade off of the 4-hour chart. The big advantage is that the liquidity 24 hours around, it really only slows down um, just before the London markets open up, and that's really where where the bulk of our traders are going to be, New Zealand and Japan. But you've got that 24-hour clock, and really the slowdown time is where in the Western United States should have taken over. And some years ago, California really should have taken over that gap between the time that New York really does slow down and New Zealand markets start to pick up a little bit. But they kind of somewhere dropped the ball there. So there's that period that the markets kind of slow down. But if you want, you know, but at the same time, you know, it's 24 hours liquidity going on these currency markets. So you can take a 4-hour chart and it'll take that slow time period and just blend it right in with the other time periods because there's only 6 of these candles in a full day's trading session. So maybe a 4-hour period really won't have the effect on it. If if you're taking on a 5-minute chart, that 4-hour period can cover your whole chart, and you can kind of get a wrong idea about what the market is really intending to do, particularly if you're watching and you're watching the market kind of die down, volatility die down, and then one of the bigger markets open up, and the volatility comes on in, and it can be a little disconcerting if you're holding on to a position there with a tight stop, and the market opens up and blows right through your stop. So you want to be aware of the time zones at the same time of trading. But one thing on the 4-hour chart here, we do see a little bit of that euro weakness here in the euro dollar. And we can see on the 4-hour chart some nice ABC moves playing out here on the euro dollar. I'm going to go through the other dollar pairs, but I really want to get into these euros. Again, it's tempting me. Not interested though. And the dollar CAD, which doesn't look as good as that. But as we get through here on some of the euro pairs, we can see that the euro is showing some weakness here in the last couple of weeks, and some nice ABC moves before that 50-period exponential moving average. I mean, these are just some nice situations to be able to take advantage of, and something we want to look forward to. Going forward into November is how long that can play. And here's probably one of the better ones. I mean, as you go through these, you can find some real strong trends, and this is also a nice one. Just a period of the lower highs and lower lows. A real nice trend here is you can really see where the market was kind of moving up, and then all of a sudden, the change. It was a long, slow change from an uptrend to a downtrend, but you can see, and this is where this moving average kind of helps you, kind of gives you a reference point at the same time, is to where the lows were, just below the moving average. Then it started where the highs were just below the moving average. Kind of gives you an idea of a trend change live, on a 4-hour chart. And if you're not particularly a short-term trader, still that 4-hour chart can be of great help for identifying trading opportunities to remain a little bit more active in the market. Because sometimes when you're trading off the daily chart, it's different if you've got $100 million under management and you're keeping your traders in for a long period of time. As individual traders, we do like to be active, not active just for the sake of doing something, but active as far as, trading and trying to find solid trading opportunities to take advantage of. So this is where the shorter term trend charts can be of great help there. And the 4-hour chart will be the first one I would look at. And of course, we're gonna have time here. We're gonna pop through those hourly charts at the same time. And you can see that the euro is kind of moving down, the pound is moving up. And again, one thing we see is that Kiwi strength, but we want to keep in its proper context, because if we look at the daily chart, we see something the opposite, to where the Kiwi, is somewhat on the weak side. this would be something that we would want to take the pound. Again, remember the pound Aussie, looked like it was ready to change. Here is a pound Kiwi. If you look at the daily on that, you can see it's moving down where it's moving opposite, okay? Pound Aussie on the daily, pound Aussie on the 4-hour is confirming that move up. The pound Kiwi on the daily, although it's moved down a little bit more, still, we've got the higher highs and higher lows, but we see some more weakness. So obviously, if you're looking to trade either the pound Aussie or the pound Kiwi, the play is the pound Aussie to continue to take advantage of this potential strong uptrend on the daily chart and the confirmation by a series of higher highs and higher lows that are looking to play out here on the 4-hour chart at the same time. Okay, now it's 22. I want to go down to the hourly chart because I know that quite a few traders like to trade a little bit more active, and the hourly chart is one of my favorites to take a peek at. You've got to be careful though a little bit on the hourly charts. You have to be more aware of what's going on the economic calendar, particularly the non-farm payroll, and particularly the central bank meetings. Those are the two that I really zone in on. Of course, the U.S. jobs report, the non-farm payroll, which is the first Friday of each month, and central bank meetings you can just find out on the economic calendars that are available. And that's usually what these moves are. As a matter of fact, that's what this one is. This was the US FOMC, the Federal Open Market Committee, which is the United States Central Bank. And those are the kind of moves you'll get when you see central banks. And I think this last week we had the US Fed and also the New Zealand Fed meeting. And which has already taken place this week. And you'll see these kind of big moves off of that. And so you don't want these to be surprises. Now in an hourly chart, you want to tiptoe around them. The 4-hour chart, I don't think you have to worry about them because it's easier to absorb that activity into the 4-hour chart. But on the hour chart, you want to tiptoe around central bank meetings and non-farm payroll. Now what I mean by tiptoe around, if you've got a winning trade and you see a central bank meeting the next day, to me it's okay to get smaller or get out. I mean, those are really your only two options, to get smaller or get out. And typically what I'll do, if I'm close to a target, I'll just take the profit and see if I can get in it again at an opportune time after the results of that meeting. But you really have to be aware of what was said at that meeting and if the fundamental picture is changing, okay? Because remember, in a strong uptrend, it's not the technicals that change the trend, it's the fundamentals. The technicals show us how we get between the high and the low. It's the fundamentals of the market, meaning the interest rate environment, the economy of the country or in the Eurozone. I mean, those are the points that determine whether the market's moving in an uptrend or a downtrend. So if you see MACD divergence, don't announce the end of the trend because that's not what's going to tell you. It's going to be a central bank announcement, a change in their pattern, a change in their wording. And that's what traders are looking for. Not so much the actual announcement that the interest rates did not move up or move down, but rather they actually will compare word for word what they said in this meeting compared to the previous meeting to see if there's any change in the bias. And that is going to have more of an effect on the markets moving forward than any physical move of the interest rate environment. A lot of times you'll see them, if the markets, say if the market should be going up after an interest rate hike, then you see the interest rate hike, but instead you see the market move down and you're trying to figure out what the heck just happened. It's because number one, most traders thought that that was the only move it was going to make and they're already looking to the next one, which is not going to happen. Or number two, that announcement afterwards made them feel that there weren't going to be any more rate hikes, okay? Traders are always looking forward out about 6 months, okay? It's the newspapers are looking at today and back. So don't get caught up. Try to realize what the difference is. Just because the market does opposite of what you think it should be doing doesn't mean that traders don't know what they're doing. They do know what they're doing on any given basis. Individually, they may not know what they're doing, but on a whole, the market is always right. And that's what things that we have to look for is determine the fundamentals of the market and the technicals of the market and the difference between the two. When we find a strong trending move, the only thing that's going to change it is the fundamentals, but how it gets between the highs and lows of that strong trending move, that's where we use the technicals. That's where we use the indicators, where we use support resistance, particularly just the trend change, to try to identify some solid trading opportunities. And we can see the euro dollar's kind of been moving down here. Let's take a little bit more in. Here we can look at the whole month, where we can see a good example. Again, maybe not as pretty as the ABC moves as we'd like to see, but certainly with the trend change, or with the 50 period exponential moving average, it kind of gives us a good reference point on the potential trend change. And it's, and it's shown us that the trend did change here, but of course it wasn't till here that we saw that confirmation. But again, right in there in the middle, there's a nice ABC move that some traders are taking advantage of. So let's compare that with the pound dollar, and we can see something similar. So again, it's really the dollar strength and weakness, and it really gets back down to that Fed meeting, and when the Fed is, what their intentions are moving forward as far as changing the interest rate environment in the U.S. So we see some ABC moves. As you can see, it gets a little choppy on the intraday charts, and you've got to be prepared for that. That's why moving out, trading is a little bit easier. Trading is definitely easier on a daily chart than it is an hourly chart. Make no mistake about it. And it's because what we're looking at right here is those short-term volatility spurts. Particularly if you get down to a 5-minute chart, you're going to see some incredible, moves in the market. But again, take it in its proper context. Take a step back and look at a daily chart, and you'll see that those moves are not quite as pronounced as they look on a 1-minute or a 5-minute chart. But on an hourly chart, we'll still see some big moves and some spikes. But we have to learn to be able to take advantage of it and accept it, because that's just the way it is. That's just the way it's going to be. But still, you can see some nice moves and a trend change. Now the market's moving up. And let's go back down to the Aussie dollar, because that's the one we want to take advantage of here. And we can see the market's moving down here. And on an hourly chart, we're going to really want to take keep an eye on this one. It can change at any time. But again, any time that you get a market moving down, remember our ABC moves, particularly below a moving average on an hourly chart in the direction of the trend on a daily chart, it really doesn't get much stronger than that. And that's the kind of situation that we're looking for in these markets, is to be able to identify those points and to identify them early enough, getting back to that Paul Tudor Jones, early enough to be able to take advantage of them, when the trend actually does change in a direction that we're anticipating it to change. Remember, we're not predicting. Predicting would be predicting a trend change. We're identifying a current trend, and we're looking for moves in that general direction in the ABC moves. So we're reacting to something the market is already doing. If it's already moving down, we're looking for selling opportunities, and not when that trend is going to end and start looking for buys. And again, we see that the Kiwi is a little bit stronger than the Aussie, so we're not seeing that pronounced move to the downside. But on the flip side, here we are. Remember, we're talking about the dollar CAD and its move to the upside. This would be an ideal situation we saw, and then we see the ABC moves playing out to the upside, to be able to take advantage of those. Since then, the market moved up strong after that FOMC announcement right here, but it's kind of faded. Again, we've got an end of the month, end of the week situation going on here, so there's a lot of administrative trading going on at the same time. So we don't want to really try to figure out on a short term what's going on in the long term, but we want to take a peek at this next week, particularly in this case, that 133 level. If the market's able to move up through there, then we want to look for a series of higher highs and higher lows, and we want to be buyers of the dollar CAD and sellers of the Aussie dollar if the market moves through these key levels. And that's what I mean by reacting. We don't want to just be buyers now and predict that it's going to move up there. We want to increase our chance of success to at least that 50% level and use that strong money management, meaning that if we're risking 50 pips on the trade, we want to look for at least 100 pips in potential profit Very difficult thing to do also, but that's what trading is. That really is what trading is all about. If we're risking 50 pips, we're looking for 100 pips of potential profit. And the reason we can have the audacity to do that is because we're trading in the direction of the trend. That will allow us to eventually, hopefully, not always, realize that gain, which is enough to be able to absorb the losses that we take, because I guarantee you will have losses if you trade. The only guarantee in the market. But if we're trading in the direction of some strong trends, a lot of times the markets can take off on us, and we can end up with some fairly big winners, but we're going to need those to absorb our losses. So think of the coin toss. Think of the 50-50 win ratio. If you're looking at heads and you get 3 tails in a row, there's nothing wrong with the coin, nothing wrong with the fact that you're calling heads. It's just a numbers game, okay? Now, admittedly, that confidence comes from having traded a certain disciplined approach to trading for a long period of time, and understand that there are going to be periods where you're going to look like you don't know what you're doing, and you have the confidence to continue to do what you're doing, because you'll find that particularly the big traders, when they have a bad month, instead of calling up and apologizing to their clients, they will call up and ask their clients to commit more funds. You think that's audacity? You better believe it is. But what they do is they'll tell them that every time they have a bad month, usually the market is in store for good, because they know that volatility is predictable. Inhale, exhale. Whenever they have a bad month, they know that some strong trending moves are coming. And some of the clients who have been with these guys long enough will, in fact, send more funds in after having a down month or a down period. And but I know it takes a lot of nerve to call a client up and ask for more money after you've had 3 losers. But they have history on their side where they know that it's eventually going to turn around in their direction, and their biggest gains can sometimes come after some of their biggest losses. Okay, so that's the kind of point you want to get that into your trading, where you have the confidence to say, I just lost 3 trades in a row. Whenever this happens, take a step back, inhale, exhale, relax, everything's okay, get back in, and because at that point in time, the markets may be ready to break out, and you can find yourselves in a nice little winning streak. I mean, it's happened to me enough to where, I'm a believer in that process. But after having lost a few trades in a row, is it easy for me to go back in on that third or fourth or whatever situation? Absolutely not. But again, when I see this, I try to do that. When I see that, I try to do that. It's the discipline that I was talking about before. The 2 things that can really mess up a solid trading approach is fear and greed, okay? Fear that you're going to lose, or fear that you've got a little bit of a gain in the trade, but the market's starting to move against you. You want to close it out because you read somewhere, never let a winner turn into a loser. Or the greed, the market's moving in your direction, and it may have gone to your target, but you want to let it keep going because, it can go, you'd have no idea how far it can go. Don't let those 2 emotions even rear their ugly head when you're in a trade, okay? Now, when you're out of a trade, you can use fear and greed to do whatever you want with, because it's not going to affect your trading from. But don't let fear and greed take over the decision-making process. Once you get into a trade, have an idea of what you want to do, where you're going to get out with a loss, where you're going to get out with a gain. Know it and then trade it. Stick with that plan. It's that plan that's going to be your best friend through trading. And everything else will just keep you from becoming a consistently profitable trader. So if you don't mind, let's kind of sum it up here, what we talked about. Number 1, and this is really the key. If you do nothing more after this webinar, please trade in the direction of some strong trends that you find. Even if you find them on a 5-minute chart, trade in the direction of a strong trend. We never know where they're going to end, and sometimes they'll last a lot longer than we anticipate. Number 2, tighten up your money management approach. Identify your risk before you get into the trade. Know how much you're willing to lose. Tell yourself, if I lost this much, would I be okay? Would I still be able to trade again? Would I be okay with it? And if the answer is yes, I'm okay with it, I'd still be able to trade again, it won't keep me up at night, then that's about the maximum risk you want to take. If it'll keep you up at night, or if it'll affect your finances, then you're taking on way too much risk. That's not trading, that's gambling. And we don't want to get into a gambling mindset here. This is pure speculation, like a professional. Professional speculators can and do make money. Gambling is when it's just numbers. Okay, it's a very different game. Okay, we want to be detached about the outcome of any one trade. Just because we've lost a trade doesn't mean that we're not smart enough to be a trader. It doesn't mean that what we're doing is wrong. Okay, you can't be a winner in trading. You can't be a winning trader until you first learn how to lose gracefully. Okay, one of my favorite trading movies is A Good Year. Albert Finney says to his young nephew, they're playing in tennis, and the uncle beats the nephew, and the nephew's all upset. And the uncle says, what's wrong? You should be celebrating with me. And he goes, well, I lost. And he tells him, you'll find that losing is inevitable. The trick is not to make a habit of it. Okay? So just because you lose a trade, there's no reason for you to change everything you're doing. Okay? Now, after a series of 100 trades, if you're not happy with the results, then you should be changing. You should be tweaking your approach. But be detached about the outcome of any one trade. You have to do that before you can move on to the next level of trading. Remain consistent in your approach, and your results should be consistent. You really can't have one without the other. Once you identify an approach to trading you're comfortable with, that you believe is profitable, stick to it. Give it a chance. Okay? First of all, you have to find out if you can actually execute it in the markets. And if you can, give it some time. And there's no guarantee that, remember, we're talking about a 50% win ratio. That doesn't mean you win one, lose one, win one, lose one. There could be losses of 5 or 6 or gains of 5 or 6 in a row. And again, if you win 5 in a row, don't consider yourself a genius, okay? Be prepared for a market change. Be prepared for a trend change. And if you can, market change, be prepared for a trend change. And if you can see when it happens, and you can react to it early enough in the change, then you're going to hang on to a lot of those funds that you had made in the previous trending move. And never stop learning more about trading. At Aura FX, these webinars are part of that, because remember, the trader on the other side of the trade is learning more about trading. You want to be at the same time. Now, I know that one of the top reasons that new traders find themselves out of the market is because of underfunded accounts. And Aura FX is we're trying to eliminate all the bad things that happen to new traders, that they come in and they're gone within 6 months, and trying to keep them around long enough so they can get to the point of being break even, so they can get to the point of being mildly profitable, obviously till they get to the point of being very profitable. And that's why we have a deposit bonus up to $10,000. Otherwise, you deposit a new account with FX, and all of this, you have to contact ORFX for all the terms and conditions of this. But you can be eligible for a bonus to feasibly double the size of your account. Just a little bit more room for error there to help you become a consistently profitable trader, because it's in our best interest for you to be a profitable trader. It's in your best interest for you to be a profitable trader. I call that a win-win situation. And also a referral bonus to bring in some other people might be interested in training. We can help with them too at the same time. And also, pro trader bonus, some top-notch research about market forecasts and trading opportunities. It's always nice to get someone else's opinion. Whether you do what they say or not is certainly up to you, but it's still very nice to get someone else's opinion. And again, please contact Aura FX about the terms and conditions of the bonuses. Again, my name has been Tom Long with Aura FX. I thank you very much for joining me today. Look forward to getting back with you at another time. And yes, it is possible to watch the recordings again, or FX will have copies of these. Contact them, and they will tell you how to get a hold of them. But between now and the time we meet again, good luck with your trading. Thanks for joining me.